Today, folks, the question we have to ask ourselves heading into this holiday season, is it time to take profit? I'm going to be giving you my full prediction, what I'm doing with my portfolio, and where I see the markets going in the next 6 to 12 months, because yes, it is relatively bearish, but I think this is going to offer a lot of clerical insight, and this entire conversation today is going to be based off of what I just watched on CNBC with this interview, which is just fascinating. So let's get right into this.
This is a market where you have to take profits. Where can I raise some cash? That was the question that Bill Baruch raised. Is it time? Because a lot of stocks have rallied a tremendous amount from the mid-October lows. Is it time to do some little line-by-line checking in your portfolio to see which ones have done the best and get out of those?
Without a doubt. Without a doubt. Unless you intend on holding those for years and years to come, which I do with some of my positions, but less of them, I think now's when you got to ring the cash register. Look, everybody's looking for a year-end rally. I've sort of cooled on that a little bit, given what the market's told us. So I think where you have profits, take them. Look at Microsoft. You can buy it back down. I'm pretty sure I can get Microsoft back down around 220 again and then ride it back up. Netflix, I should be able to get that a lot lower as well. So, yeah, take profits where you can, absolutely.
Now, let's talk about the tech stocks first and foremost before we talk about the stocks that have actually done well this year, because Apple, a lot of these tech companies haven't really experienced an exuberated holiday rally like we've seen with many companies and the S&P kind of coming through October and November. Apple trades at this hefty premium, guys. Off its recent lows, it's only up 5%, down 21% year to date, looking like it's going to finish down here in 2022. Microsoft probably having the best rally of the top tech giants, up 15% from those lows with a higher value than even Apple, down 26% year to date. And Amazon not even getting a glimpse of hope here. You know, through that Black Friday sale event, we didn't see any crazy lineups. There's a glutton of technology with TVs and stuff like at Best Buy. And considering Walmart and Target took the place of the most shoppers over Amazon for Black Friday, you know, Amazon down 46.98%. It's just really bleeding up to this kind of unfortunate, gloomy look into the first quarter of 2023. Now, let's listen to a little bit more of this, and I'm going to tell you my exact predictions over the next 6 months and how I'm going to basically be molding my portfolio just to kind of cushion myself and get prepared for what I think is coming and the real opportunity ahead.
Was that where you would look? I mean, and some of these tech stocks have done, a fair amount from the mid-October lows, but there are so many sectors that you've seen a lot of stocks run an awful lot. I mean, you really have to do some good combing through your portfolio to find some of these things to get out of, and then take the risk, though, as you said, Steve, of missing a year-end rally, which a lot of folks think can still happen.
Yeah, and the calendar still has 31 days in it, so that's growing shorter and shorter for the rally. We've had a big move to now through November. I just don't think it's going to continue. If it does continue, frankly, it's going to be a small kind of muted rally because we've seen most of the fat of that rally. And then if you go to next year, I'm very negative on the first quarter, definitely maybe the second quarter. So rather than trying to time it with precision, take the profits when you have them rather than being piggish about it. At least sell some of it. Maybe you don't want to sell the whole position, but take some off the table.
All right, good stuff.
Now, the fact of the matter here is hedge funds specifically and these big investment firms have had more cash on their balance sheet than they've basically seen in 20 years. But when this is the sentiment driving the market, I highly, highly doubt, and even considering I just had a meeting with a bank advisor saying there are record people throwing money into GICs and bonds and just trying to sideline the market for the time being, it's no surprise that this sentiment, this bearish sentiment, is going to continue to push the market. But that's not the only thing. The reason that I think we're going to start seeing a downturn in the market is because oil commodities are starting to crash. Now, the fact is the S&P, a lot of these ETFs that I hold have been held up primarily just because of consumer staples and oil markets, but there's no way Exxon, there's no way Chevron are going to be posting record profits coming into Q1 when we're seeing such a decline from the peak of oil here when it was sitting at $112 a barrel. And taking a look, this does put some fear in my eyes when it comes to things like VDY, my Canadian high dividend yield ETF, fixated on the Canadian economy, where I think 20 or 30% of this ETF is in energy, and 50% is sitting basically in the financial sector. And I really don't think we've seen the full impact of these interest rate hikes just yet. We're just starting to see people feel the pressure of variable rate mortgages, people that have mortgages coming up for renewals. We're starting to see that show in the balance sheets of companies like Canadian Imperial Bank, Bank of Nova Scotia that just posted earnings. Somehow TD and Royal Bank have been proving very resilient, but that doesn't mean we're going to continue to see that resiliency depending on how hard the real estate market gets affected here. Taking a look at VDY is only down 3.66% year to date, but it could really roll over depending on what energy does. VOO here, guys, you're seeing Exxon make its way back into the top 10 S&P 500 list. If tech companies can continue to be kind of as a value investor focused thing where they're overvalued, energy's up there, and those things start to roll off, there wouldn't be much of a surprise that we start seeing this sell off quite a little bit. So what am I doing with my money? Well, firstly, the only place I've really made money this year within my portfolio has been through the US dollar. Now, there used to be a 1-for-1 correlation here. Let me zoom this out. The US dollar has been the best asset you could have held through 2022, basically outside of oil and a few select, sectors. But take a look at this, because many of you know throughout the year, the best thing that happened to me was stacking cash to pay my taxes. I ended up having almost $30,000 in USD, which I flipped out of to pay my taxes in October, which made me over 10%. But the thing is as this was rallying, the stock market was dropping. And then as the US dollar started to drop off, the market started to rally back. But now we're not seeing the same 1-for-1 correlation. The dollar continues to drop, but the market doesn't continue to rally. Now, as many of you know, right in this moment, before we talk about what I think the next 6 months is going to look like, I have been aggressively stacking cash. I watched the market rally. I got tired of buying the October lows, and now is the time to take that cash and start funneling it, for me anyways, aggressively into bonds or GICs for that matter, very similar assets, because after having that meeting with the bank, they're not listed on this Scotiabank website, but they told me you could get a 24-month GIC at 4% that is cashable at any time. And a lot of people were like, hey Kyle, 4% doesn't keep up with inflation. Well, newsflash, inflation isn't going to stay high forever. It's going to roll off. And if the Fed or the Canadian Treasury ever pivot, these wonderfully high rates that we haven't seen since the 2008 financial crisis are going to disappear. They're not going to be here forever. So if I can lock some in, take 10% of my portfolio and get it jammed in here for the next 6 months, I would feel a lot more comfortable for the opportunity that I think we're about to see. And that opportunity is going to exist as soon as the Canadian Treasury starts feeling the max pain of this economy. Right now, what we're going to see is a continued kind of flat line or downturn, from my humble opinion, in the market, because earnings aren't going to be anything robust. We haven't seen any crazy earnings out of any of the major tech companies. They've been nominalizing and coming down, especially with companies like Google, Facebook, anything marketing related. And the final domino to fall is going to be the real estate market, where there's going to be some massive opportunities coming up as people aren't going to be able to afford their mortgages, and you're going to be able to buy those assets at probably relatively reduced prices. But what's going to happen is inflation has to roll off first. And inflation, as I mentioned, is based off a 12-month trailing period. So the inflation that we saw back in, March and April is still affecting the total inflation rate. But from July till now, it's at a nominal 3 to 4% rate, which is where the Bank of Canada is trying to get it, where the Federal Reserve wants it to be. The problem is we're not going to see that rate actually show on the numbers until a 12-month trailing catches up. And that won't be until spring of next year. So you're looking at March, April, May. And then once that happens, we know we're already seeing the last little bit of these interest rate hikes. And then depending on how much pain is existing in the economy, if jobs start to really get hindered, that's when the Canadian Treasury, that's when the Fed will start to pivot, and if anything, start bringing the rates down. And that's when the market is really going to start to take off again, in my humble opinion. I mean, this isn't really rocket science. There's still cash all over the markets. I'm still very bullish long term. I'm still cost averaging into these index funds and a lot of these companies that I bought because I still want them for the long term. But it's not hard to look around and be like, if this is the sentiment, this is how all the big pension funds, all the big hedge funds are currently feeling. And as the bank advisor told me, there's just a record amount of people buying GICs and bonds right now. So in the meantime, why not collect a healthy 4 to 5% and just wait and just be patient and see what happens? I still have my buy list of stocks I want to load the boat on. I just don't think right now is the most prudent time to be just throwing endless amounts of capital at it. I know I've talked about Tesla. I really want that. It continues to sell off. Waiting is proving to be in my favor. Northland Power is one that I think is starting to trade at a very good value here. We're talking about companies like Google. I'm looking at some small cap companies I might even buy in the nearer term, just because they're obviously more speculative in nature and there's no point putting a value on them until they get to future cash flow. But nonetheless, you just need to be careful, cautious, and realize that having no debt, things I preached on this channel, guys, absolutely no debt. Pay the credit cards off, start making sure your job's reliable, and stack some cash and keep cost averaging and just waiting for these opportunities to arise, because there's going to be nothing crazier than your neighbor defaulting on their mortgage and that house coming up for sale for 30-40% less than it's likely worth, because again, the volume's just dried up in real estate sales. I mean, these are real wealth building moments, guys, and I just wanted to take it seriously and see it for what it is. Obviously, I could be completely wrong about all this, but if I am, I'm going to be fine. I have so much money in the markets. I've stated this again, guys. I can be fine if the market goes up, and I'll be even better if it goes down because I'm positioning myself to be that way. So I want to know what you guys think in that comment section below.